Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, US stocks trading heavy yesterday. Not too dramatically, but definitely feeling heavy. Month-end selling coming in. I think there was about $1 billion imbalance to sell on the close. That kind of taking the market down. But then once that was absorbed, we did see a little knee-jerk back higher again overnight. France and Spain keeping pressure on yields with higher inflation data. Same thing in Germany. But overnight, we have had China PMIs come in strong and above expectations and showing some expansion there finally. So the China reopening narrative may be back on. And we're finally starting to see the first bit of hard data come through there. And as a result, Chinese stocks have bounced and commodities have also bounced. So commodities started to bounce already yesterday, finding some stabilization there off those support levels we've been mentioning in gold and silver, having a little rally there. Copper also up 2%. Nat gas still rallying. Oil having a bounce as well. Only commodity that was in the red was uranium. And that's kind of doing its own thing, right? So in general, commodities liking that news and also liking the fact that the dollar was retreating a bit from its recent highs. Volatility-wise, we did see Vols lower. Another about half a vol again in US and European Vols. VIX Vols also getting whacked. And commodity Vols kind of down across the board, except for copper. Small higher, but that's because copper's realizing like a madman, which is why it's got 50% negative carry. If we look at skew, bit mixed, seeing Asian skew and FTSE skew bouncing, seeing a NASDAQ and Russell bouncing, and then seeing European skew softer. So a bit of a mixed picture there. In terms of commodities, we're seeing skew softer in energy and uranium picking up a little bit. Okay, that's the summary. Moving on. So we've said Chinese PMI beat overnight, highest print since April 2012, returning back to expansion territory. Like I say, the hard data that we've been looking for regarding a Chinese reopening finally starting to show up. Chinese stocks were lifted by the news. Commodities like industrial metals, even precious metals were higher, as was oil. Now, last month, the reopening narrative did take a pause. So we're going to be watching closely to see if China exposed assets can recover and build some positive momentum again. They've obviously had a knee-jerk higher now. Going to have to watch this over the next couple of weeks. Markets consolidating near the lows on S&P, though, over the last few days as the dollar's retreated. What have we seen in downside protection? Remember, we saw a bunch of downside protection and skew popping here through January, February. Market sold off, so that was a good trade to buy that downside. But now look what they've done to skew. They've puked skew in the last few days, basically. Okay, so that and that's whilst the S&P hasn't really managed to recover. The S&P's kind of hung in near those local lows, touched 39.50 yesterday yet again. So is that a sign? We do think that's a bit of a divergence from the volatility complex and the options market versus what spot is doing. So we do think people monetizing hedges there, market makers getting a bit more comfortable of where the vol should be priced on the downside. All these things reflect the potential that a tactical rally in stocks may be on the cards. So whether it happens now, whether we need ISM services on Friday to get out the way or not, we do think there's potential for a rally, maybe for a rally to last into non-farm payrolls next week, next Friday. And payrolls itself could be a really big event as well. Okay, so that's what we're thinking there. If we look at the fixed strike volatility surface on S&P, always good to see what's going on under the hood. So this is for the last 2 days. You see S&P hasn't moved. No move since last Friday's close. What has happened to the surface? You see a sea of red here. You see a little bit of a bid to the upside in the very front end, but that's very low premium options. So I wouldn't read too much into that. But really the thing to read into is all this downside action getting crushed, right? So these downside puts in March, April, June, particularly April and June, right? This stuff getting hit quite hard relative to the upside. So that's something that we're seeing skew, repricing lower, showing that there's potentially less fear now from market makers, that positioning being unwound, some puts getting taken off potentially. That sort of stuff should make you a bit more tactically bullish, thinking that this S&P may have some room to bounce. It doesn't mean you have to be structurally bullish, right? If you're fundamentally bearish, but the options market is giving you a signal that things are not as acutely stressed as they were a week or two ago. and we've had the move down. We've repriced the rates market. So at the margin, there is room for a bit of a relief rally from what we're seeing in the options surface, in the S&P surface. Translating that to the VIX as well. What are we seeing in the VIX? Another interesting data point here. We know there's been a lot of call activity, a lot of call buying on the VIX, which has been pumping up the VVIX, which is the vol of the VIX. That has collapsed now. If you look at the graph on VVIX, the white line has sold off pretty dramatically, went from a 95 back to around 80 on VVIX. And it's kind of led the VIX lower. The VIX itself is the green line. It has come down. It got to around 23. It's back to around 20 and a half now. But we know this stuff can go as low as 18. It did get onto a 17 handle in January. So the question now is, has this VVIX led the VIX lower? And do we need to see that VIX reprice back towards that 18 level? Now, it may be that the VIX needs to hold up into the FOMC meeting on the 22nd, 23rd of March. And then it needs to move lower. So it might be a case of that. So you might not want to go too short dated on that view, but there certainly is potential for, you know, that FOMC meeting to kind of be the crescendo in terms of volatility, and things can normalize. Markets can kind of have a bit of a relief rally that, okay, the Fed has confirmed the repricing of rates, but we don't need to push that repricing even further. And now we can get some relief and we can say, okay, the job has been done, basically, in terms of repricing the rates outlook. So that there is potential for there. And if that is how things play out, volatility is going to head lower after that meeting. So in terms of opportunities, I mean, if that's the view you subscribe to, then, you know, when we see VVIX dropping and the VIX dropping, but just not so hard, generally my antenna goes up to look at VIX puts, because VIX puts are going to be priced as a function of where the VVIX is, basically. If the VVIX is really, really low now, then it means VIX puts are going to look quite low in terms of their pricing. So if we look at this chart here on the right-hand side at the bottom, what we've got is we've got the orange line that shows you the price of the option. And the option I've homed in on here is the April VIX 18 strike puts. Okay, so they're low delta puts on VIX if the VIX was to collapse back to around 18. Now, we're looking at the implied volatility on that option, which is the green line. So the green line is the price of the option. The option is currently priced at around 40 cents. The white line is the implied vol of that option, which peaked at 65 and is now currently sitting at around 56. So that's dropped quite considerably at the same time as the VIX itself, which is the orange line, has dropped pretty hard as well. That went from 23, this orange line, to around 20 where it is now. So as we've had VIX collapsing, what has happened to the price of the option? That's the green line. It hasn't moved, right? So when you've got a case with the VIX collapsing, but the option that is a put on the VIX that should be increasing in value is not moving, it's because that implied vol is collapsing with the VIX. So now in the next leg down on the VIX, if we are going to get another leg down on the VIX, you're looking at a nice cheap level of implied vol on this option, and this option price can really explode. And if that option price explodes, it can go back towards, you know, 70 cents or even $1 where it was in kind of middle of February or early February. That's the kind of upside potential you've got for that next leg down in the VIX. So the idea is you can own this option at 40 cents, which is the same price it was when the VIX was 3 vols higher, because the implied vol has given you a discount. Okay, so that's how you identify value in these options, right? You want to see these options aren't performing because the vol is working against the delta. And then once you think that's kind of reached its limit and now the vol isn't going to do that anymore, and if you get the delta move you're looking for, the option is going to be explosive. That's when you want to own these options, basically, right? So the timing on is now this option has value. Now this option is, you're getting the implied vol at a good level, and it should perform the way you would expect if the VIX heads lower. Okay, that's it for today. Thanks again for listening as always, and I'll catch you guys tomorrow.